Dara Sharif here. I want to talk a little bit about private equity and how it works. There's a few videos I want to do that get into specifics related to private equity. So first, let's dial it back to the very origin here and talk about how they're set up. So if you're talking about private equity, you have to talk about the GP and the LP. So the GP is the general partnership. Those are the folks in the fund who are deploying the capital, right? They're the ones who are seeking out investments and making the investments. The limited partners, the LPs, are the folks who make the investments into the fund. So they are the money behind the fund, and the GP are the folks deploying that money. They were entrusted by the LPs to deploy and then manage the fund, right? So the folks who serve as LPs tend to be institutional investors like endowments of universities. You look at insurance companies that have incredible pools of capital that they have to invest to make sure they have the money to make, to pay out claims when it comes in. So they do deploy some money into alternatives like private equity, venture, hedge, et cetera. And then also pension funds. When I was raising a venture fund, the Commonwealth of Pennsylvania invested into the fund. So those kinds of investors, and then also sometimes high net worth and ultra high net worth individuals and family offices. Those serve as the LPs, and the GP deploys the money. The GP gets paid in a couple of ways. So traditionally, it's been sort of a 2 and 20 structure. You may have heard that before. So 2% of the fund every year comes out and is deployed into the GP to fund operations, right? To pay salaries and travel and all the stuff that they do with the money. And these folks live pretty well. So their salaries are higher than the average person's salary, but they really make their money on that 20 piece, which is the carried interest piece. So when you exit a business, so they've invested into a business, they've helped to grow it, and now they're going to sell it, which is the mandate. That is what they're built to do. The proceeds from that are deployed 80% to the LPs, who are the investors, and 20% go to the GP. That's how they get their upside, right? So first they're paid, the LPs are paid back for what they've invested into it, their expenses, that 2% over the course of time, they're paid that back. And then the upside is where the folks that you think of as being private equity folk, that's how they make their money. And they have an advantaged tax status on that money now. It's a bit of a loophole. And it's taxed right now as long-term capital gains, not ordinary income, which some folks agree with, some folks don't. The folks who agree tend to be the ones who are taking advantage of it, right? So that's kind of how it works. That's how they're incentivized. They're incentivized to have great investments, make a lot of money in the investments, and then sell them for a huge upside, and they participate on the upside. So that is the structure. We'll go deeper into some specifics there on other videos. I think the next one I'll do will be on continuation vehicles, but I had to do this video first to lay out how these funds work, how they're organized before getting specific. So I look forward to doing the next one, and please do continue to follow.